Good day. Today, our group will discuss key concepts in international finance using Toyota Motor Corporation as our primary example. We will explore how multinational corporations manage accounting, funding sources, stock markets, junior stock markets, and foreign direct investment incentives. So, by the end of this presentation, we should be able to understand the role of accounting in international finance, identify different sources of funds for multinational corporations, explain how stock markets support corporate growth, differentiate junior stock markets from main stock markets, analyze the importance of FDI incentives in global expansion, and apply the concepts using Toyota as a real world example. So let's dive in. What is international finance? It refers to the management of financial transactions that occur across countries. So it includes foreign investments, currency exchange, international trade financing, global capital markets, and cross border business expansions. It's important because it helps companies operate globally. It supports international trade, it facilitates economic growth, and it enables access to global funding opportunities. Now, let's meet our primary example that we'll be using throughout this discussion, Toyota Motor Corporation. It was founded in 1937 in Japan under the automotive manufacturing industry. It operates in over 170 countries with manufacturing plants worldwide. It sells millions of vehicles annually. Some of its popular brands include Toyota, Lexus, Daihatsu, and Hino. So, why did we choose Toyota? We chose it for its strong international operations, and it is listed in major stock exchanges. It also has large scale foreign investments, and it's an excellent example of a global financial management strategy. So, international accounting is a process of recording, analyzing, and reporting financial information across different countries. For multinational companies like Toyota, this is important because they operate globally and earn revenues in different currencies such as Japanese yen, US dollar, and euro. Some key challenges include the difference in accounting standards, tax regulations, currency conversion, and exchange rate fluctuations. Toyota also needs to consolidate financial reports from all of its subsidiaries worldwide into one unified financial statement. This matters because international accounting ensures transparency, comparability, and accurate decision making for investors and management. So, Toyota uses several international accounting practices to manage its global operations. First, the company prepares consolidated financial statements to combine all worldwide subsidiaries into one report. Second, Toyota performs currency translation adjustments because revenues earned overseas might be converted into Japanese yen. The company also uses global auditing systems to maintain compliance and transparency across countries. Lastly, Toyota applies financial risk management strategies such as hedging to reduce the impact of exchange rate fluctuations and market volatility. Toyota also follows IFRS or International Financial Reporting Standards to improve comparability with other global companies. So in FY 2026, Toyota's vehicle sales reached approximately 9.595 million units, increasing by around 233,000 units compared to the previous fiscal year. Net revenues also increased by 5.5%, reaching 50.684 trillion yen or approximately 335.7 billion US dollars. This increase shows that Toyota continued to experience strong global demand, particularly in overseas markets. Despite economic uncertainty, the company maintained strong sales performance because of its global brand reputation and diversified market presence. This reflects Toyota's ability to generate stable revenues even in a challenging international environment. So, although Toyota's revenues increased, profitability actually declined during FY 2026. Operating income decreased from 4.795 trillion yen to 3.766 trillion yen, while net income also fell from 4.765 trillion yen to 3.848 trillion yen. This happened because Toyota faced several global financial pressures. These included rising labor costs, inflation, higher investments in electric vehicles and research and development, tariffs, and foreign exchange fluctuations. This means that while Toyota sold more vehicles, the cost of operating globally also became much more expensive. This slide highlights an important lesson in international finance. Higher sales do not always mean higher profits. This slide shows Toyota's capital investments, research and development expenses, and vehicle production performance. We can see that Toyota continued increasing its investments in R&D over the years. This reflects the company's long-term strategy on focusing on innovation, electrification, hybrid technology, and sustainable mobility. Toyota is sacrificing part of its short-term profitability to remain competitive in the future automotive market. This chart also shows that overseas vehicle production remains significantly larger than domestic production, demonstrating Toyota's strong global manufacturing network and international expansion. So this slide presents Toyota's global vehicle distribution. North America remains one of Toyota's largest overseas markets, while Japan continues to serve as a stable domestic base. Europe and Asia also contribute significantly to overall sales. The diversification of Toyota sales across multiple regions helps reduce dependence on one single market. This is important in international finance because economic downturns in one region can be offset by a stronger performance in another. However, regional differences also expose Toyota to varying risks such as tariffs, inflation, geopolitical instability, and currency fluctuations. So this slide shows Toyota's key financial ratios from FY 2021 to FY 2025. We can observe that operating margins and returns on assets improved over time before slightly declining in FY 2025 due to increasing global costs. Return on equity or ROE increased from 10.2% in FY 2021 to 13.6% in FY 2025, showing stronger shareholder returns over time. Meanwhile, Toyota's shareholders' equity ratio remained relatively stable, indicating strong financial stability and healthy capitalization. Overall, these ratios show that despite the recent profitability pressures, Toyota remains financially resilient and continues to maintain strong long-term performance.
Moving on to the different sources of fundings in international finance, which can be grouped into three primary categories: private funding sources, public funding sources, and institutional and market-based funding sources. Private funding sources are those that flow from private entities in one country to another, commonly driven by market returns and commercial interests. Under this category, we have foreign direct investments or FDIs. FDIs are long-term investments where an investor from one country establishes a significant stake in an enterprise in another country, often in exchange for a certain degree of managerial control beyond passive stock market holdings. So these can be in the form of greenfield investments, mergers and acquisitions, or joint ventures. For Toyota, FDIs are the backbone of its global expansion strategy. In March 2026, Toyota invested $1 billion across its US operations, the bulk of which is to modernize its largest factory plant located in Kentucky. It has also very recently invested roughly $1.9 billion to establish three new vehicle assembly plants in India, to have production factories in close proximity to a high-growth market, to reduce transport costs, and to build local supply chains. Next, foreign portfolio investments or FPIs are a passive purchase of another country's financial assets for investors who are seeking a financial return through dividends, interest, or capital appreciation without exerting managerial control. FPIs are generally more volatile than FDIs because these assets are highly liquid and can be sold quickly. As a global blue-chip stock, Toyota is one of the most widely held equities in the world, creating a constant flow of portfolio capital into Japan. At the same time, Toyota itself also has its own short-term portfolio investments. Third, we have commercial banks. These banks are the cornerstone of international finance because they provide foreign currency loans and advances worldwide, including specialized financing for international trade. They offer both international loans, which are foreign currency credit extended to fund corporations' non-trade operations, and trade credit, or short-term arrangements between businesses that allows an importer to pay suppliers at a later date. Toyota regularly secures pre-arranged loans from major banks worldwide, which serves as a flexible financial safety net that it can draw from for general corporate purposes. Fourth, we have venture capitals and private equities. These are high-risk, high-reward investments made by firms or funds into private companies. Venture capitals typically focus on high-growth startups, while private equities often target more mature companies. Regardless, both of these aim to raise capital for a business's expansion and innovation projects, particularly in high-growth sectors like technology, renewable energy, and e-commerce. To illustrate, Toyota has a VC arm called Toyota Ventures that invests internationally in search of breakthrough technologies. For example, in the San Francisco Bay Area, it also operates the Frontier Funds, which invest in startups focused on developing AI, robotics, and climate technology. In May 2026, Toyota also committed to the Mirai Creation Fund IV, a venture capital fund of funds managed by the Sparks Group, to outsource parts of its VC strategy and gain exposure to promising technologies. Lastly, under private sources, we have remittances, which are personal financial transfers made by migrants back to their home countries. Although these are household level flows, the aggregate scale makes remittances a major source of external finance for many developing economies. However, as a corporate entity, Toyota doesn't use these as a funding source. On to the second category, public fund sources are those provided by the government and government agencies, often used to promote economic development, stability, or other national strategic interests. Under this category, we have the Official Development Assistance or ODA. This is a government aid coordinated by the OECD to promote the economic development and welfare of developing countries. It's considered the gold standard of foreign aid and supplies over two-thirds of the external finance for the least developed countries worldwide, primarily through grants and concessional soft loans. Toyota directly benefits from the ODA when it receives concessional financing from the government and government-backed development banks to fund projects in developing countries. For example, Toyota received funding support for its assembly line in the Mombasa region in Kenya. JBIC loans also enabled its partnership in Angolan social infrastructure projects. Sovereign Wealth Funds, or SWFs, are state owned investment funds funded by governments through commodity revenues, budget surpluses, or forex reserves. They are often invested in public and private assets, often managed independently, to stabilize a country's economy or to generate long term returns. While Toyota doesn't benefit directly from SWFs, they remain a significant source of foreign portfolio investments for the company's publicly traded stock. Meanwhile, export credit agencies are government backed institutions that provide financial support to domestic exporters and foreign buyers, easing financing and protecting them against the risks that come with conducting international business. These are a core part of Toyota's financing models, with the Japan Bank for International Cooperation or the GBIC notably providing the company loans to manage currency risks and to fund their car sales in international subsidiaries. Finally, we have the institutional and market-based sources, which are somewhere in between private and public sources. We have the international agencies, which are supranational institutions owned by multiple governments, and development banks, which are government-backed lenders that offer loans to uplift weaker economic sectors. Together, they finance development projects that lack sufficient private capital. Notable sample institutions include the World Bank Group, the IMF, and regional banks like the ADB. Last but not least, the international capital market, which enables large corporations and governments to raise funds directly from global investors without bank intermediation. Instruments under this funding source include Global Depository Receipts and American Depository Receipts. These are negotiable certificates that let a company trade its share on overseas stock exchange. We also have foreign currency convertible bonds, which are bonds that are convertible into equity shares in the issuing company. Historically, Toyota has utilized the international capital market through international bond issuances and a Level 1 ADR on the New York Stock Exchange.
So now we'll be moving on to stock markets. So to start, a stock market is an organized marketplace where investors can buy and sell shares of a publicly listed company. When we say shares, we're referring to partial ownership in a company. So for example, if an investor buys Toyota shares, that investor does not own the whole company, but they own a small part of Toyota and become one of its shareholders. This matters because shareholders gain a financial claim on the company's future performance. If the company performs well, earns higher profits, or gains investor confidence, the value of its shares may increase. But if the company faces challenges, the share price can also decline. Stock markets serve several important functions. First, they allow ownership because investors can participate in a company's growth. Second, they support capital raising since companies can use the money from investors to fund expansion, research, factories, or new technology. Third, they provide liquidity, meaning shareholders can sell their shares instead of being permanently locked into the investment. And lastly, stock markets help with price discovery because the stock price reflects how investors assess the company's performance, strategy, risk, and future potential. So overall, stock markets connect companies that need capital with investors who are looking for returns. Moving on to the Japanese stock market. The main exchange in Japan is the Tokyo Stock Exchange, or TSE. It's operated by the Japan Exchange Group, also known as JPX. The Tokyo Stock Exchange is one of the most important financial markets in Asia because it includes many globally recognized Japanese companies. Some examples are Toyota, Sony, Mitsubishi, Fast Retailing, Honda, and Nintendo. These firms are not only important in Japan, but are also internationally known, so their presence in the exchange makes the Japanese stock market significant for global investors. The TSE is divided into different market segments. The prime market is mainly for large and globally competitive companies. These are firms that want strong credibility with both local and international investors. The standard market is for stable public companies. These firms are already established, but they may not necessarily have the same global focus or scale as prime companies. The growth market is for startups and high growth companies. These firms may have strong future potential, but they also involve higher uncertainty. Lastly, Tokyo Pro Market is designed for companies that mainly target professional investors. So the Japanese stock market is not just one broad category. It has different segments depending on the company's size, maturity, growth potential, and investor target. What makes the Japanese stock market unique is that it reflects both Japan's traditional corporate culture and its ongoing reforms. One major change was the 2022 market restructuring. Before this, the Tokyo Stock Exchange had older categories like the first section, second section, mothers, and JASDAQ. In 2022, these were reorganized into the current prime, standard, and growth markets. The purpose was to make the categories clearer and easier for investors to understand. Another unique feature is the rise of shareholder activism in Japan. Traditionally, Japanese firms were known for stable relationships with banks, suppliers, and other companies. However, in recent years, more investors have been pushing companies to improve governance, increase transparency, and make better use of capital. The slide shows that contested resolutions among Nikkei 225 companies increased from 11.8% in 2022 to 13.1% in the year to June 2024. This suggests that shareholders are becoming more active in questioning management decisions. Another important issue is cross shareholding. This happens when companies hold shares in each other, often to maintain long term business relationships. While this can create stability, it can also reduce accountability because companies may support each other instead of challenging weak performance. Because of this, firms are now being pressured to reduce cross shareholdings or explain why they still hold them. So overall, Japan's stock market is unique because it is moving from a more relationship-based corporate system toward a system that emphasizes transparency, efficiency, and shareholder engagement. This explains the 2022 market restructuring in more detail. Before 2022, the TSE had several segments. The first section was mainly for large and established Japanese companies, and it was often considered the main board. After the restructuring, many of these companies moved to the prime market, although some moved to the standard market depending on whether they met the requirements. The second section was for smaller or mid sized established companies. After the restructuring, most of these companies moved to the standard market, which is now the category for stable listed companies that meet basic public listing standards. Then there was Mothers, which focused on startups and emerging high growth companies. After 2022, this became part of the growth market, which is now for companies with high future growth potential but also higher risk. There were also the JASDAQ Standard and JASDAQ Growth segments. JASDAQ Standard was for smaller or emerging firms with more stable business profiles, so these mostly fit into the standard market. JASDAQ Growth was for firms with stronger growth potential, so these moved to the growth market. The main purpose of this restructuring was to make the market easier to understand. Instead of having several overlapping categories, the TSE created three clearer segments: Prime for large and globally focused firms, Standard for stable listed firms, and Growth for high potential emerging companies. This restructuring is important because it shows Japan's effort to make its stock market more attractive and understandable for investors, especially foreign investors. Now, applying this to Toyota. Toyota is one of Japan's most important listed companies. It was first listed on the first section of the Tokyo, Nagoya, and Osaka stock exchanges in May 1949. This means Toyota has had a long history as a publicly listed company, and its stock market presence has supported its growth from a domestic Japanese automaker into one of the world's leading automobile companies. Toyota is also part of the Nikkei 225 with the stock code 7203 under automobiles and auto parts. Being included in the Nikkei 225 matters because this index represents many of Japan's top listed companies. For Toyota, this reinforces its visibility and importance in Japan's economy and stock market. Toyota also had overseas listings in New York and London in September 1999. This was significant because it helped Toyota reach more international investors and strengthen its global credibility. A company listed in major international financial centers is usually seen as more transparent and more accessible to global capital markets. In terms of shareholder base, as of March 31, 2025, Toyota reported over 15.7 billion shares issued and more than 1.18 million shareholders. This shows that Toyota has a very broad shareholder base, which includes many investors who have a financial interest in the company's performance. For 2026 stock prices, the slide notes that Toyota stock has been volatile. It reached around 4,000 yen in February 2026, but by May 13, 2026, it was around 2,939.5 yen. This shows that even a large and established company like Toyota is still exposed to market movements. Its stock price can be affected by profits, exchange rates, investor expectations, and developments in the global automobile industry. Finally, this slide summarizes why stock markets matter to Toyota. On the advantages side, Toyota's listing helped the company access investors and raise credibility. Being publicly listed made Toyota more visible and more investable, especially after its New York and London listings in 1999. This was important because Toyota was expanding globally and needed to be seen not just as a Japanese company, but as a global corporation. Listing also helped Toyota build trust with investors because public companies are expected to disclose financial information, follow listing requirements, and be accountable to shareholders. This can improve corporate reputation and make the company more attractive to both domestic and foreign investors. However, there are also disadvantages. Because Toyota is publicly listed, it is exposed to public market pressure. This includes stock price volatility, short term investor expectations, and scrutiny over governance and capital allocation. For example, if investors feel that Toyota is not using capital efficiently or is too slow in responding to industry changes, this can affect market confidence. So, being listed gives Toyota access to capital, credibility, and global investors, but it also means the company must constantly manage public expectations and maintain investor trust. To conclude, Toyota's stock market experience shows how stock markets are not only platforms for buying and selling shares, they also shape how companies raise capital, build credibility, respond to investors, and compete globally.
A junior stock market is a type of stock exchange where small and growing companies can raise capital by offering shares to the public. It has a low entry barrier, allowing companies to gain visibility and credibility since they are listed on a junior market, helping them attract investment. A junior stock market can also support these companies' growth and development by providing a platform for them to connect with potential partners and customers. Unlike a main market, a junior stock market is less regulated
and offers more flexibility to companies regarding disclosure requirements. While companies listed on the junior market aren't required to meet the same stringent financial reporting requirements as those listed on the main market, they still have to provide investors with adequate financial performance and operational information. These junior markets are characterized by simplified listing processes and by the formal rules issued by the market operator that govern exchanges in a particular market. Formal rules include listing requirements, roles of financial intermediaries, and level of information disclosure. The main objective of the junior market is to provide small and medium sized companies with access to capital markets to support their growth and expansion. It encourages entrepreneurship and innovation, making it an attractive option for companies that need help accessing traditional sources of financing, like venture capital or bank loans. On the other hand, junior markets are a great way for investors to diversify a portfolio, but it requires careful consideration and due diligence. Junior stock markets also offer a lot of advantages. For companies, it's easier and cheaper to get listed. It offers increased public visibility and credibility, and there's better access to investors and potential business partners. For investors, there's an opportunity for higher returns, and also offers portfolio diversification and better access to emerging companies with growth potential. Junior stock markets also offer a lot of advantages. But, like everything, junior stock markets have their own risks and limitations. First, there's a higher investment risk due to smaller companies being mostly the ones listed on the junior stock market. Second, companies may have limited operating histories since a lot of them are new. Third, there may be less liquidity compared to main stock markets. And fourth, there's usually a greater volatility in share prices. A junior market is operated by securities exchanges, which also provide market makers who facilitate trading by providing liquidity to buyers and sellers. However, junior markets are usually less liquid than the main market, so buying and selling shares may be a bit harder. Examples of junior markets include the Alternative Investment Market in the UK, TSX Venture Exchange in Canada, the Jamaica Stock Exchange Junior Market in Jamaica, Euronext Growth, which was formerly called Alternext in Europe, Kosdaq in Korea, and Jasdaq in Japan.
This was already briefly discussed earlier, but let's now dive into foreign direct investments or FDI and how governments use incentives to attract multinational companies such as Toyota. Foreign direct investment happens when a company invests in and establishes business operations in another country. Unlike short term investments, FDI involves long term ownership or significant control over a foreign business. FDI is an important driver of globalization because it allows companies to expand internationally while also helping economies grow through investments, job creation, and technology transfer. Now, let's talk more about the advantages of FDI for countries and for the companies or the investors. As mentioned earlier, FDI benefits the host country because it creates jobs and employment opportunities, encourages technology and skills transfer, increases foreign capital and investments, and contributes to the growth of local industries and infrastructure. Overall, it supports economic growth. Because of these benefits, many governments compete to attract foreign investors by offering different incentives. On the other hand, for the firm, FDI allows access to new international markets, lower production and operating costs, better access to resources and suppliers, and increased global competitiveness. Companies may also benefit from government incentives and tax breaks. One example of a multinational company that actively engages in FDI is Toyota. Toyota has invested in many countries, including the Philippines, United States, South Africa, Australia, France, and Brazil. Its investments include manufacturing plants, assembly facilities, supply chain partnerships, and research and development centers. Toyota's global expansion strategy allows the company to produce vehicles closer to consumers, reduce transportation costs, and adapt products to local markets. At the same time, Toyota's investments contribute to industrial development and employment generation in host countries. For example, as of an article they released in November 2025, Toyota employs approximately 50,000 people in the US alone. Now, I've mentioned this multiple times already, but what exactly are FDI incentives? FDI incentives are benefits offered by governments to attract foreign investors and multinational companies. The main purpose of these incentives is to reduce business costs and encourage companies to establish or expand operations within a country.
Governments provide these incentives because they want to attract more investments that can stimulate economic growth, increase exports, improve infrastructure, generate employment opportunities, and the other advantages I mentioned earlier. There are two main types of FDI incentives: fiscal and non fiscal incentives. Fiscal incentives are financial or tax related benefits. Examples include income tax holidays, reduced corporate tax rates, tax credits, and duty free importation of equipment and raw materials. Meanwhile, non fiscal incentives focus on making business operations easier and more attractive. These include simplified business procedures, infrastructure support, employment of foreign nationals, and guaranteed repatriation of investments and profits. Together, these incentives help reduce costs, minimize operational barriers, and encourage multinational firms to invest in the country. Now, in the Philippines, the government provides several incentives to attract foreign direct investments. First are tax incentives, such as income tax holidays lasting 4 to 7 years, a 5% preferential tax for export firms, and enhanced deductions for research, labor, and training expenses. Second are trade incentives, including duty free importation, as well as VAT exemptions or zero rating for registered activities. Now, lastly, the Philippines also offers investment support or non fiscal incentives. These include foreign ownership opportunities in selected sectors, profit repatriation, long term land leases, and simplified business processes within the Philippine Economic Zone Authority and Board of Investments ecozones. These incentives may aim to make the Philippines more competitive in attracting multinational investors. A current example of FDA incentives in the Philippines is the government support for electric vehicle manufacturing. Under the current EV incentive strategy, which is still subject to finalization, four participants may receive up to 15 billion pesos worth of fiscal support in exchange for investments in EV manufacturing. That's a total of 60 billion pesos. And one of the companies that they are targeting is Toyota. This initiative shows how governments use incentives strategically to attract investments in future oriented and high growth industries. Here are more examples of FDI incentives using Toyota. In the United Kingdom and France, Toyota received research and training grants that help reduce the cost of transitioning to the Toyota New Global Architecture Platform. In the United States, infrastructure and land support reduced Toyota's time to market by providing ready to build locations. In Thailand, excise tax cuts made Toyota vehicles more affordable for local consumers, strengthening Toyota's market position. In Brazil, VAT credit monetization allowed Toyota to use tax credits to support factory expansion. And finally, in Indonesia, Toyota benefited from tax holidays that exempted the company from corporate taxes for more than a decade. These examples show how incentives can influence where multinational companies choose to invest. Despite the benefits of FDI and FDI incentives, there are also risks and criticisms. So, for companies, FDI comes with risks such as political and regulatory uncertainty, high investment costs, exchange rate fluctuations, and cultural or management challenges. There is also the possibility that firms become too dependent on incentives, making investments less sustainable in the long term. For governments, incentives may lead to loss of tax revenue, unequal distribution of benefits, and dependence on multinational corporations affecting local businesses. Some critics also argue that countries engage in a race to the bottom competition by continuously lowering taxes and regulations just to attract investors. To conclude, FDI and FDI incentives play a major role in attracting investments, creating jobs, and encouraging knowledge transfer. However, these incentives must be carefully designed and managed. Governments need to ensure that long term economic and social benefits outweigh the fiscal costs and possible risks. Using Toyota as an example, we can see how multinational companies respond strongly to incentives provided by different countries. Ultimately, successful FDI policies should create a balance where both investors and host countries benefit sustainably. So that's the end of our presentation on international finance with Toyota as an example. Thank you for listening.